Hello and welcome to the Business Talk podcast. I am your host Deepak. I am honored and welcome Professor Sandeep Goel, Professor of Accounting, Finance and Corporate Governance at Management Development Institute, Gurgaon, as our esteemed guest on today's podcast episode. Dr. Sandeep Goel holds a double doctorate, one in finance and another in accounting, from the Faculty of Management Studies, University of Delhi. He earned his honors degree in commerce from Shri Ram College of Commerce, University of Delhi, and completed his masters in commerce with a specialization in finance from the Department of Commerce, Delhi School of Economics, University of Delhi. Dr. Goel brings 3 decades of rich experience spanning industry and academia, having held key positions at esteemed institutions and organizations, including the Shri Ram Group, the University of Delhi, and the Management Development Institute, Gurgaon. In addition to his academic and corporate roles, he has hands-on experience managing business compliance and financial operations in his family business. Currently, Dr. Goel serves as an independent director on the board of Machino Plastics Ltd, a Suzuki joint venture and a BSE listed company. He is a distinguished expert in forensic accounting, fraud risk management, and corporate governance. His academic contributions extend globally, and he is a visiting professor at the Faculty of Management, University of Lodz, Poland, Aix-Marseille Graduate School of Management at France, and several premium institutions in India, including IIMs. MDI Gurgaon, he teaches the highly sought course Forensic Accounting and Corporate Governance to MBA students, furthering his commitment to shaping the next generation of finance and government professionals. In this episode, Professor Sandeep Goel will share valuable insights from the upgraded edition of his book, Finance for Non-Finance People. Professor Sandeep Goel, it is an honor and privilege to have you join us today.
Same here, sir. Thank you. Thank you for inviting me.
Dr. Goel, your book simplifies finance for those without a financial background. What inspired you to write Finance for Non-Finance People, and what key challenges do non-finance professionals face in understanding business finance?
Basically, I started a program called as Finance for Non-Finance Executives almost 25 years back when I ventured into academia. And I found out a lot of people in HR and marketing and operations as non-finance domain. They are dealing with finance, but without knowing finance. And that's where the challenge comes out. They should be knowing finance, not only as a part of integral learning, but also as a part of business decision making. And that's where the thought came out, and it grew over the years by these programs and consulting assignments on financial proficiency and literacy. And plus, something which I found out in my teaching career as well, that when I teach part-time and executive education programs, I find a lot of senior people dealing finance and taking finance as a part of day-to-day application, but without knowing the nitty-gritties of finance. And that's where this thought became as a part of mindset and as a part of strong application to come out something maybe a good, but a basic literature on finance. And that's where this Finance for Non-Finance People came out originally a couple of years back. And then we got revised this in 2019, and ultimately the present edition is the most concise, updated, and yet comprehensive edition on finance for non-finance people. Now, coming to the second part, what are the challenges? Again, it's all about dealing with finance as a part of decision making. Most of the key important challenges which emerge out to non-finance people is to analyze financial statements for taking various decisions. What is the top line, bottom line? How do you gauge the performance of a company as a net worth application? What are the cost nitty-gritties as a part of management and proficiency? How does financial market operate? What financial systems and constituents we have, not only in India, but worldwide? So these are some issues which they normally face in day-to-day life, both at a personal level and at a corporate level. So this is something which again makes this book very relevant and at the same time very basic and essential to those non-finance people. But having said that, it is not only for non-finance people. It is equally useful and relevant for finance professionals as well, because we have taken cases at a part of not only national level application but global level. Like when we talk about Unilever or let's say Apple or Indian multinational companies. So this brings out equal challenges and relevant value add to both finance and non-finance people as well.
You discuss fundamental accounting and finance concepts. What are the top 3 financial principles that every non-finance professional should master to make informed decisions?
Well, that's something which again brings out to basic accounting principles, which we call as GAAP, generally accepted accounting principles. And when they become standards, we call them IFRS, International Financial Reporting Standards. In India, we call them as IND-AS. And to talk about on these accounting principles and standards, if I narrow down, the first basic principle would be business entity concept or business entity principle, where normally we say that you should keep your personal affairs strictly separate from the business. Because if you start mixing your personal affairs with business, it violates the entity and the sanctity of business application as a part of corporate governance. And that's where business and owners should be treated as separate entity. Like we take an example, let's say as a business, you like to invest something into a application for startup, for expansion, for diversification. So generally we treat it as capital in accounting system. But if you withdraw anything, it becomes an asset for the business. So that's what business entity concept is all about, where you need to treat both business and the owners separate from each other, so that the entire sanctity of corporate governance and transparency is maintained, so that everybody should know about to keep their affairs completely separate from the business. That is what business entity concept is all about. It lays down the foundation of accounting system. Second is something which again brings down the importance of monetary transactions. We call as money measurement concept, because accounting is wide, accounting is diverse, but at the same time, accounting has a limitation. We record only those things which are monetary in nature, like anything which is monetized, anything which is quantified, we record in the books of account. Let's say I have a machine, I have a furniture. I can't record machine and furniture unless I assign some value to them. So money measurement says that record only monetary transactions, don't record anything non-monetary. So in a way it becomes limitation, but somewhere it brings down the essence of monetary items in the financial statements. So that is concept or the principle number 2, money measurement. The third and the most important concept is dual aspect. Why? Because we normally don't record anything from one perspective. We take it always as double entry application, that whatever business withdraws, it becomes a liability. Whatever business owns, it becomes an asset. And that's the whole idea we talk about as dual aspect. Like, let's say I buy a machine, it doesn't have a single entry application, because for business, if I buy a machine, it would be an asset for the business. But at the same time, the item of cash balance goes out. So there is a withdrawal in the asset at the same time. So plus and minus both. That is what double entry concept is all about. Double entry actually brings out a uniformity about twin aspects of accounting that do not record anything which is one dimensional. Basically, it balances your assets with liabilities plus equity. And that's where, again, the premise of accounting system is built on, where we talk about that accounting system is based on double entry or derived from dual aspect principle.
The book introduces tools for financial analysis, monitoring, and resource allocation. Can you share a real-world example where these tools help a company improve its financial health?
Yeah, rather for that part, I have a specific chapter in the book called as financial analysis. because as I said in the initial talk, that at a personal level and at a corporate level, you need to analyze financial statements, especially from five perspectives. One is how profitable the business is, how liquid the business is business sound or not, what is the operating efficiency of a business, and last but not the least, what is the market performance of a company in the stock market. So these are the areas which everybody should know about, both at a personal and a corporate level, because at a personal level, it's all about personal finance. And at a corporate level, it's all about business decision making. So what I have done is I have taken two comparative companies in the same sector, automobile, which comes under a manufacturing sector. And I have taken two leading Indian companies that with multinational operations, global presence. One is Maruti Suzuki, which is again a listed company in India. Second is from the Tata Group, Tata Motors. So what I have done is I've taken their last year financials for 5 years and analyzed on these five parameters and gave the readers a basic insight, intricacy into the actual numbers, how to analyze. And this becomes relevant. Why? Because we are analyzing one industry, but two comparative companies. So obviously you can't compare apples with oranges. You need to compare apples with apples. And that's where this comparison, this analysis becomes very relevant. And at the end, after this analysis, I have drawn a conclusion, but I have left it to the readers to come out and make a meaningful analysis that how do they feel, what are the company's actually financial strength and weaknesses are, how do they look like based on these five parameters. So this makes this financial analysis not only reliable, authentic, but also practical at the same time. So if somebody wants to invest into a company like Maruti or Tata Motors at a personal level, he can again look at indicators like price earning multiple. If somebody wants to talk about at a corporate level, he can look at indicators like current ratio, liquid ratio, or maybe indicators like gross profit margin, EBITDA margins. So both personal and corporate applications are being covered based on these five parameters with the help of these financials. And the story does not end here. Why? Because within this chapter, at the end, I have taken two different sectors which are completely diverse and apart from a sector like automobile or a manufacturing. So I have taken a banking sector which is governed by RBI and banking regulation norms like SBI and ICICI Bank, which is again comparative, but in a diverse sector like BFSI and a telecom sector like Idea and Vodafone. Within the same chapter, I have gone slightly beyond national presence. And that's where I have talked about companies like Apple, companies like Unilever. Apple comes from US, Unilever comes from UK. So again, different companies, different sectors, and different countries. That makes the analysis all the more relevant and insightful. And I think readers would enjoy this, not only enjoy it a learning experience, but also enjoy it at a value add level, both from the perspective of personal and corporate planning. I hope it makes sense.
Insightful, Dr. Goel. Professor, given the book's global perspective, how do financial management practices differ across regions? And what lessons can businesses learn from international corporate finance strategies?
Well, every country is not similar. It is as simple as that. Every man is not similar. Every individual is different. Same goes with the company, and rather it becomes more diverse at the country level. In US, if I talk about for costing, we use a method called as LIFO, last in, first out. But in India, under NDAS, LIFO is not allowed. We normally go by FIFO and other methods of inventory valuation. Similarly, when I talk about financial standards, as I started introducing about IFRS and AS, in India, we go by IFRS, but in US, we go by US GAAP. So that brings the difference in compliance, in reporting, in functional analysis, and in the challenges. And that's where the entire line lies down, that to analyze a company in US, I need to aware about the US GAAP. But to analyze a company in India, I need to aware about the Ind AS. That's where the entire application is strengthened upon based on the different challenges. And this compliance and regulatory differences bring out the challenges of financial nature at international level. Like somebody which is in US or Europe, they would be more debt oriented because they are more debt oriented developed economies. Whereas in India or in other parts, especially in the Southeast, we talk about equity dominance. So let's say as a company like Microsoft or as a company like General Motors in US or a company like Unilever in UK, if I have to go about and raising funds, I would be more looking for debt, debentures, bonds as a part of borrowed obligation. But if I talk about India, it's more conservative. It's more on a positive side as a equity dominance. And that's the reason mostly in India, you find debt equity ratio to be on a lower side, unless you have sectors like power, steel, telecom, but majorly you find equity to be more dominated. And this brings the challenges at the corporate level in different countries, different nations, and different implications.
Finance often comes with complex terminology. What are some of the most misunderstood financial terms, and how can professionals simplify financial communication in a business settings?
Well, I would be more than happy and elated to answer this because on day-to-day basis, I come with these challenges to my young MBA students, to my executive participants, to my training programs, to consulting assignments, and even sitting in the board. Normally, finance is misinterpreted as an area with full of jargons. It is, but it is not at the same time. Why? Because they seem jargons at the outset. They seem jargons from the outer appearance. But if you go deeper into this, they are very simple. Rather, they come out and give you a very different application on a meaningful basis, on a detailed insight. Like if I talk about a company's performance, I would rather say go from top to bottom. Now, a lot of people might be using these terms, top line and bottom line. When we sit in board meeting, we simply ask three important indicators or jargons. Let me know the top line, bottom line, EBITDAs, net worth. So they seem technical, but they are not, because top line is all about like your CTC, total income. Bottom line is all about your profit, take away salary, net income. So if I combine with individual example, for an individual, the top line would be CTC, the bottom line would be takeaway. But for a business, the top line for Reliance would be not only from petrochemicals, it would be from textiles, geo, and other industries. So the total income which comes to a company like Reliance would be the top line. But after meeting all expenses, right from manufacturing to office to marketing expenses, what you are left out with, that is what we talk about bottom line. That's why I simply said that I might be getting a salary of X amount, but the whole challenge lies out, or whole challenge brings down what I am left out with. So left out is your bottom line, which is net profit. And that is where you come out and distribute dividend to shareholders. Similarly, there's an item called as net worth. And we generally say that look at and invest in a company, go buy a company which has a positive net worth. Now, what is this net worth is? Net worth is something A minus L. And I'm coming out with this net worth in my blog next month, maybe in the first week, and people can just go and check out that blog on my website, sandeepgl.com. This is where I've tried to unleash the basic implications of net worth, because net worth is again your corpus, your residual, which is after meeting all your liabilities from assets. So if somebody has a positive net worth, increasing net worth, the company is sound. And that is equally applicable to an individual. So I think one common man or as a manager should be knowing about these technical terminologies which are used in day-to-day sense for business applications and decision making. Top line, bottom line, net worth. And the last item which I want everybody should know about is EBITDA. EBITDA is an acronym which stands for earning before interest, tax, depreciation, and amortization. In simple terms, if I have to simplify, I would call it as operating profit, core profit. Anything which is before non-operating items, before non-operating charges is always an operating profit. But it's an operating profit which comes out as a cash operating margin. And this brings down the strength of a company in real terms. If, let's say, a company has a negative PAT means negative profit, that is losses, but a positive EBITDA, I would still say the company is good, because EBITDA is all about operating profit, whereas PAT is about total profit. So these are some terminologies which I've tried to unleash in my book, Finance for Non-Finance. That's the reason I reiterate and reinforce that this is both for finance professionals with diverse corporate examples, with topics like taxation and financial markets, but immense use going to be there for non-finance people as personal and corporate level.
Dr. Goel, your book covers financial accounting, cost accounting, financial management, financial markets, and tax planning. How do these 5 domains interconnect, and which one do you think is most crucial for business leaders?
They are the 5 facets or 5 dimensions of finance. If I have to bring down to finance into simple 5 elements, I will start with something financial accounting. That is financial reporting, where we introduce and expose everybody with financial statements, analysis, and everything. So one should start with always a basic finance sense, basic finance acumen, basic finance understanding about these key indicators which we talked about just a couple of minutes back. Then it's not about reporting and compliance and financial decision making, it goes backward. And when I say backward, I mean by cost control. I might have a lower profit, but can I maximize my profit? Yes, I can, if I'm able to minimize my cost. So the idea is not always to look forward. The idea is always not to look forward, but also sometimes to look backward, which actually leads to cost reduction, cost management and control. That's where we talk about budgeting, managerial decision making, cost control, cost applications, and something where we talk about cost as a relevant indicator for target costing. Nano is the best example of target costing, where the price was decided first and the cost was looked later on. So the first part is you start with financial understanding of financial statements, that is financial accounting. Then you go backward and look at cost control and management. Based on these financial indicators and cost implications, you build on financial management, that is corporate finance. And corporate finance or financial management, I normally decide as that these are about 3 Ds: investment, financing, and dividend. When I say investment, it's all about capex and working capital. When I say financing, it's all about funding between equity and debt. A very important component comes out here called as WACC, weighted average cost of capital. The entire financing can be fine-tuned with simple WACC restructuring. And third part of financial management is all about SWM, shareholders wealth maximization. That is, you are actually maximizing shareholder value by dividends, by bonus, by buyback, and other indicators. So one starts with financial reporting proficiency, goes for cost control, looks at financial management from 3Ds, that is investment, financing, and dividend. Fourth, ultimately every business, every corporate, every organization has to deal with financial markets. One should know what markets they operate in: money market, capital market, stock exchanges, financial systems, mutual funds. That is where the pillar number 4 or facet number 4 comes out: financial markets. And ultimately it brings down and concludes to tax planning, where not only individuals but cooperative societies and individuals at a basic level should know about tax planning and management. That's where the last pillar comes out: tax planning. So basically these 5 pillars define the entire story of finance into simple 5 basic steps. Start with proficiency, that is financial accounting. Go for cost management, that is cost accounting. Go for financial decisions, that is financial management. Check out your financial systems and markets, that is financial markets. And last but not the least, tax planning. So these are the 5 sutras or 5 indicators or facets of finance proficiency and literacy. That is what I try to interlink and interconnect these 5 facets of finance into one volume. So it's a simply one hand window or one hand solution for entire financial theory and practice.
Professor Goel, my last question. The book includes corporate case studies. Can you share a compelling case study from the book that highlights a major financial lesson for business executives and entrepreneurs?
Yes, rather this book is full of corporate cases. This is basically integrated with corporate cases. As I said, the prime case which I have taken in financial analysis is Maruti Suzuki and Tata Motors, which actually has been analyzed on all the 5 indicators which I introduced in the mid of the talk about financial analysis of profitability, liquidity, solvency, efficiency, and market valuation. I've taken diverse sectors like banking, where I talked about SBI and ICICI Bank. I have extended and not confined to domestic level. I have taken this to global level of Apple and Unilever. Similarly, if we talk about financial management, I have taken examples from other sectors also, like DLF, like other companies in realty sector. I've also taken examples for bonus, buyback, and split of diverse companies which are not confined to only Tata Motors or Maruti. And obviously in tax planning, there has been a live case which has been simulated for tax calculation and tax understanding. And plus there's an hypothetical case which I have disguised for the obvious reasons, called as Indian cloth mills in financial part, where I've taken the capex, NPVs, IRR and analyzed in detail. So the cases are a perfect icing on the cake. The cases are a perfect blend on the facet of financial management. So basically cases don't take it backward, they take it forward. They basically extend the theory and practice of finance with live examples. And that is what the learnings are, that number 1, how to analyze finance in terms of financial business decision making. Second, what are the cost management tools and control techniques. Third, how you can analyze the financial management choices and decision making. Fourth, what are the instruments and financial markets you can look up to. And again, the last one would be how to plan out and manage your taxes. So these could be the key learnings which could which could come out from these basic cases and examples. And rest assured, and mind me, Dr. Deepak, that this is something which is lucid yet comprehensive. At the same time, I take a pride in this, that none of the existing books talk about in such a simple and a thoughtful manner about financial concepts in one single volume. So what I'll say is, check out this book of mine, and this would be very useful both at a personal and at a financial level in terms of financial literacy. And obviously, I am many ways there at your disposal, for every reader's disposal. My mail ID is there in the book, sandeepgoel18@rediffmail.com. They can always contact me. I would be more than happy to help out, to answer their queries. But go and grab a copy right now. I hope you enjoy this.
Listeners, it has been an absolute privilege to have Professor Sandeep Goel with us today. His deep expertise in accounting, finance, and corporate governance, combined with his vast academic and industry experience, and provided us with invaluable insights. From breaking down complex financial concepts to sharing practical tools for financial analysis and decision making, Professor Goel has made finance more accessible for non-finance professionals. His book, Finance for Non-Finance People, serves as a powerful guide for business leaders, entrepreneurs, and management professionals looking to strengthen their financial acumen. Thank you once again, Professor Sandeep Goel, for joining us on Business Talk.
Thank you, Mr. Deepak. It was a pleasure indeed. Thank you.
Thank you.